Hi, Todd Rosenbluth here at the home of the New York Stock Exchange talking about ETFs with some of my friends at Pimco. So you guys just recently launched ETFs, a new ETF that you're going to be ringing the bell today. But let's talk about the preferred securities market. What should advisors know about that?
Well, first of all, the first point to note is that preferreds are predominantly issued by financial institutions. So the first angle of the product, if I may, is that this is an asset class where we've seen some very clear improvements in the underlying credit quality of the issuers over the past 10 years after the great financial crisis. That's the first point. It's an improving credit fundamentals asset class. There aren't that many out there, so that's the first point to stress. The second one is that with regards to preferreds, it is a very tax-efficient instrument for investors. In this product, PRFD, our ETF that we recently launched, a vast majority of the security will be eligible for qualified dividend income, which means that essentially you get to pay much lower capital gains tax on your positions. So I think that's a very significant angle of the product as well. And then finally, the other angle is that ease of trade and very strong execution for retail investors as well that look to maximize income. That is a big benefit as well of the ETF format.
So, Amit, let's just talk about how preferred securities held up in 2022.
Look, 2022 was a rough year for the risk markets. Whether you look at stocks, S&P was down 18%, NASDAQ was down 33%. The bond market was also down. Preferreds were not immune. Certain parts of the preferred market actually performed much better than more interest rate sensitive assets. Within preferreds, institutional preferreds, which have a better structure, fixed to float, have lower interest rate sensitivity, they trade over the counter, fared much better. They were down roughly about 10%. Retail preferreds, which trade on the exchange, they are $25 fixed for life, have higher interest rate sensitivity. They fared worse. They were down by about 15%. We actually saw significant selling in the end of December, and primarily because retail investors were selling for tax loss harvesting. The good part is we came into the year with valuations that were attractive, i.e. yields that were high. Year to date, we have seen some good tailwind in the product, so yields have come down some, but we still think it's a good entry point for buying preferreds, especially using the Pimco PRFD ETF, which is actively managed and has a diversified portfolio.
Let's talk about the new ETF just to make sure investors understand what it is. Talk about the investment approach that you're using.
Yeah, so it's the proven, tested in Pimco investment process. We start with our macro views. In the context of this product, which is a more specialist type of area, we spend a lot of time selecting the issuers, building on our macro views. So for instance, in this product, we invest in US banks, but also in non-US banks and in insurance companies, as well as in other sectors that issue preferred, such as pipelines, utilities, energy companies. So based on our macro views, we will take a first slice into of where we want to be. Once we've done that, we will select which sector in terms of underlying bottoms-up quality we should go for. So if we say, for instance, that we like UK banks because they have rebuilt their capital positions to very good levels and the trading levels offer you like a big pickup to US banks at the moment, we say what's the best slice of the capital structure we want to be invested in and which bank in itself makes the most sense. More retail-oriented banks, more investment banking-oriented banks. At the moment, I would say we want to be a bit more cautious about institutions that would have a lot of exposure to, say, subprime lending, for instance, because we're heading potentially into a weaker macro environment, potentially a recession. So we want to be more sensitive and careful when it comes to institutions that are going to be more severely hit, perhaps by the recession.
So thanks, Philippe. So, let's just talk about the benefits of this being an actively managed approach that the two of you are running. What's the benefits of an active ETF?
Sure, so we truly believe that ETF as a wrapper is a fit product for allocating to actively managed, diversified preferred. And I would say three reasons. Number one, ease of use. Second, liquidity. Third, tax efficiency. So if you look at ease of use, you have a single simple share class. The assets have portability across custodians, which makes it easier for advisors. And then there is no minimum investment amount, no holding period, and I would say no hidden transaction fees or friction. Drilling down on liquidity, what has happened is that ETF as an asset class has emerged as the primary source of liquidity for certain asset classes which are less liquid or less efficient. This happens because they have an in-kind transfer mechanism as compared to cash bond transactions. Also, the ETF trading ecosystem allows for very tight bid-ask spreads, providing investors an efficient way to allocate to preferreds. And lastly, on tax efficiency, we feel that the ETF structure would get you closer to 90% of QDI, which is tax advantage, tax at the lower rate, roughly about 20% for high net worth individual, and that happens primarily because of the ETF structure. So combine all these three things, we truly feel that actively managed diversified portfolio provided in the ETF wrapper is the best way for investors to approach this asset class.
Well, thanks a lot, Philippe. Amit, congratulations on the brand new ETF. Thank you for joining us for ETF 360. Have a great day from Vetify.